We're very interested in trying to figure out how AI is going to impact research. We've got, I think, 350, 400 research analysts in Bloomberg Intelligence, and we know absolutely that AI is going to impact them. The question is how. And we talk with lots of institutional traders, and they're absolutely looking at putting a lot of the research into an AI model and summarizing that stuff. And then the question becomes is, if I put in 20 Intel reports on Intel, does the AI care which 20 reports it consumes? How do you be the number one, or how do you get AI to say, oh, the stuff that Larry wrote was great, so I really want to talk to Larry? I think we're wrestling with that and trying to understand what that means and how that impacts the creation of research. And I'm not sure we have any answers, but I think it's something we need to, I think everybody in this business needs to think about.
Why are we seeing record volume?
What it means, I have no clue. The kind of record volumes we're seeing over the last 2 years have just been off the charts. We're talking crisis level volumes. We've been tracking, at least on the equity shares and value traded in the U.S., over 18 billion shares turned over a day, or over 900 billion in value turned over. There were 2 times during the global financial crisis. There was the flash crash, and then you have 10 years not hitting any of those levels. Then you wind up, with COVID, and there were a couple of days in 2000. And now all of a sudden, almost every single day, you're turning over 18, 20 billion shares a day and over $1 trillion in value. These are bond market numbers. They're not equity market volumes. And then with that comes, the zero-DTE volumes, the equity options volumes are through the roof. Is this Trump? Is this all, the radical reshifting of the regulatory framework and the direction of geopolitical, the deglobalization of the world? Is this that increasingly liquidity begets liquidity, and we're not, it's not just, Vanguard trading with Fidelity. This is, the rise of the retail investor and the global nature. A couple of years ago, I did an event in London talking about equity derivatives, and it wasn't equity derivatives for Europe. It was all these guys in London, full house of folks who wanted to better understand, how do I trade U.S. options from Europe? And I think what we're seeing is that the liquidity is begetting liquidity. You've got not just folks in London, but folks in Europe wanting to trade the U.S. complex. We see the drive to 24/5 markets trying to open up during Asian daylight hours. All of this stuff is basically bringing in liquidity into the U.S. market, and we're just seeing volumes go through the roof. Now, traditionally, when you see these kind of high volumes, it's crises. But every single day we're having crisis level volumes. Then the question is, what happens when there's a real crisis? Do we double from there? I don't know. Sitting here in BOCA RATON, that's probably a good thing for the U.S. But if I was a global exchange, if I was Singapore exchange, if I was Hong Kong, or Tokyo, or Paris or Lisbon or UK, I would be kind of worried about that.
What does the volume chart look like during the day?
90% of the equity volumes happen in the regular session, so 9:30 to 4. And 10% happens outside in the pre and post. 4.5% happens in the morning. 4.5% happens in the post session, most of which is in the first half hour and the last half hour in the morning and the first half hour in the afternoon session. And about 1% happens in the overnight. And that's picked up. It used to be 0.25% to probably about 0.5%, but Korea opened up, and U.S. has been a big outlet for the Korean and the Korean equity traders. Yes, they're buying blue chips, but they also like buying these meme stocks and low price stocks. You look at the volume going through Blue Ocean and a good percentage of it is sub $5 stocks, so they're very, very speculative leverage stuff.
What are the prospects for single stock futures?
We've tried this before and they haven't succeeded. On the other hand, I think the environment's very different than it was 5, 7, 10 years ago. I think whether it was COVID and the closing of sports and all this stuff, which pushed people to start trading more options and more equities and the rise of prediction markets and the rise of zero-DTE options, I think the environment now is probably much better, especially if they do things in the micro mini size, like to engage individual investors. I think people are looking for leverage. People are looking for fast contracts. Look, when you and I started in this business, you were lucky to get a 1 month option. Now they're looking at single stock, daily options, which opens up a whole nother issue. People's demand to manage risk or play a hunch or insulate themselves from a daily event, I think, has become a lot greater. And the access to retail has been a lot more, and you've got the likes of Robinhood and some of these guys providing greater access. So I think whether it's successful or not, I think it's not going to be an easy road to hoe, because you've got to provide access. There's education, there's knowledge, there's experience. The demand for leverage products is greater now than I think than any time in our history of 35, 40 years in the market.
Are zero-DTEs essentially single stock futures?
You've got a 30-day option. A lot of what you're paying for is the time value of, the time premium. If I want to get an option on Apple or IBM or whatever, and I want to do it for a month, there's 30 days that price could either go up or down below my strike price. Whereas at a zero-DTE, I'm betting on what happens by 4:30 or 5 o'clock. And so the time premium is virtually zero. So you can get an awful lot of leverage and an awful lot of bang for your buck, but on the other hand, you got to be right or you lose your whole premium. The reduction of that time premium has made these much, much more attractive, as well as the education and the framework, and you can look at profiles of what's going to be in the money and not out of the money, and the percentages of winning and losing. It's really completely changed the profile of how to invest in these products. When I started seeing the zero-DTEs take off, I was like, this has got to end badly. That people are going to blow themselves up, and it hasn't happened. And so there must be a much better, interface, education, knowledge about investing in these products that these guys have not blown up. And so you got to the industry has to pat themselves on the back that they've actually done a good job of making sure that the people who are buying these things either know what's going to happen or they have enough capital to withstand, the challenges.
What do you think of the CBOE prediction market payout zone?
I thought it was really interesting. The maybe contract. I'm a fan of prediction markets. I like, the two-sided nature of them. When you look at gambling and you're betting against the house, and, if you're too smart, they just shut you down. I think that's not good. On the other hand, I'm not a big fan of being able to, place sports bets from your brokerage account. It takes a lot of, wherewithal to invest and save and make sure you can retire or buy a house or send your kids to college or whatever you want to do, or, take that trip. To be able to go easily parlay that into a bet on the White Sox or whatever, or the Cubs or, the Patriots from Massachusetts, I'm not sure that's such a great idea. I kind of rather see those separated. I don't mind if Kalshi does both. Having easy access to that, I'm not sure is such a great thing. But on the other hand, you got access to zero-DTE and other types of contracts. So I don't know, maybe I'm just an old guy. But the maybe market is interesting. I think that, in the prediction side, either, if I get 90% of the way there, but I don't get 100%, I lose everything. Having a product that, if I get 90% of the way there, maybe I get 80 to 80% of my payout or whatever the economics turn out to be. I think that's an interesting idea. How they do it, that's going to be challenging. I think they're doing it as kind of a very options-oriented. So if I'm betting on a single stock, which they're not actually doing now, I wind up with exercise issues, and I might wind up getting delivery of stock, and the price of the close may not necessarily be the 4 o'clock. It may be when the OCC, closes up. There's some nuances that may need to get tailored for the retail market to kind of, get them to understand that this is not exactly like a Kalshi contract.
Is the global phenomena of retail trading a good thing?
Providing individuals with the ability to alter, their financial wherewithal, I think that's a good thing. And to manage risk and to get them involved in finance and in improving their lot in life is a good thing. Having them blow up and lose everything is a bad thing. And maybe it's some of the technologies that the folks like Robinhood have created to help them, understand the downside risk and avail themselves of the upside risk. I don't know what's wrong with that. People generally tend not to be idiots. Or if they tend to do idiotic things, they tend to learn from them. You need to let investors experiment and learn on their own. I think this whole idea that I know better than the billion people in India or the 350 million people in the US is bad. I think you're insulting the people of your country. Do they have a bad trade or two? I'm sure everyone has a bad trade or two, but hopefully you learn from that and you learn, oh, I lost here. What could I have done to protect my downside? What could I have done to protect, my upside? And maybe it's just investing in the Nifty 50 and just letting the 50 top Indian stocks do better and just ride the wave up. I'm not a big fan of really active trading. I think it's really hard to make a living. We've known plenty of people who've crashed and burned. But do you want to stop people from doing that? And hopefully over time they either learn how to be more successful or they change their investment view to be something a little bit more long-term. You undercut the ability to invest in new companies and create new entities and create jobs and improve the economy and do all this other good stuff if you stop people from doing the other stuff. You've got to assume that people are not going to do things that are in their worst interest over the long run.
What do you think about stablecoins?
I'm very high on stablecoins and very high on infrastructure. I think the central banks have done themselves a disservice by not investing in real-time payment systems for decades. And I think that's allowed for stablecoins to open up. But we heard in that talk with Terry Duffy that they're going to have a CME stablecoin. And it's like, what does that mean? Are we going to interact in the John Lothian stablecoin? I don't know. Or the Larry Tabb stablecoin? How are these things going to fit? I don't know. I think that's interesting. Securities tokens are a little harder. It's like, what's in it? What am I buying? I kind of like what DTCC is doing. They're taking something off their book entry system and putting it on the blockchain. But all those wallets are going to be KYC'd. So if I want to send it to some guy in Asia, I'm not sure that's going to work. So how all this stuff works and how it all flows, I think will be very, very interesting to see how it all plays out. If I have a stable coin and it's in my phone and I go to a restaurant, do I whip out my Amex card or my Visa or MasterCard? The restaurant winds up paying a couple of percent, merchant fee and whatever, and it takes time to get paid if you're the restaurant. Why don't I just whip out my wallet and pay with stable coins? They get their money. They maybe give me a discount or give me some more benefits. Why do I need Amex or MasterCard to facilitate that? Or why is the merchant fee so high? If I have stable coins in my pocket, why can't I loan them out? So if John Lothian or Larry Tabb needs a loan, why do I need to go to Bank of America? I just put it in some pool and have it lend out in stable coins. Depending upon what happens with Clarity and the Genius Act, that may wind up being our future, which is a much more disintermediated banking future. So if I go and buy a share of Amazon stock, I go through 17 exchanges, 33 dark pools, half a dozen market makers to find the best price, okay? And it costs me nothing, okay? If I want to go wire money to the UK, unless the fees could take up everything that I want to send to London. It's like, why does it cost so much money to do it? It's not that complicated, So I think tokens and coins will have a really significant impact in our future.